Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It is great to be back. And honestly, looking at the feeds this morning, I don't think we could have picked a better day to do this.
No kidding. We really have a
Mhm.
situation here. I was looking at the charts while drinking my coffee, and just for context for everyone, today is Tuesday, January 27, 2026, and I legitimately thought my screen was glitching.
I had the same reaction.
Gold has officially smashed through the $5,100 mark per ounce. Silver's right there with it, hitting these crazy new highs.
It's a historic moment. I mean, we're seeing numbers on the screen that would have sounded like absolute science fiction.
Right.
Or just, wild hyperbole only a few years ago.
Exactly. $5,000 gold used to be something you'd hear on, like, conspiracy forums. Now it's the headline on the morning news. And it got me thinking. Usually, when gold goes parabolic like this, it's basically a report card saying the U.S. dollar is failing the class.
That's a very fair assessment. Gold is often seen as the anti-dollar. When one looks weak, the other looks strong.
Right. And historically, when the dollar gets threatened like this, the government, the powers that be, they step in. They don't just sit there. They have ways to smack the price back down.
They absolutely do, or at least they used to. They have a specific toolkit that's worked for decades to control these kinds of outbreaks.
But this time, it's just crickets. Nothing seemed to be working. The price just keeps climbing. So the question we're tackling in this deep dive is, why? Why hasn't the U.S. government pulled the emergency brake?
That is the multi-trillion-dollar question. And to understand it, we have to look at the data and some recent analysis that suggests the game has just fundamentally changed.
Okay.
We're going to look at the three historical ways the U.S. used to crush gold rallies and why, according to the research, all three of those breaks are completely broken in 2026.
I love a good mechanical analogy. So imagine the U.S. economy is this speeding car. For almost 100 years, it had three reliable brakes to slow down the gold price whenever it got too fast.
A perfect way to frame it.
But now we're driving down this steep mountain, we press the brakes, and nothing happens.
It's actually scarier than that. The argument here is that in this specific economic environment, pressing those old brakes might actually cause the car to flip over.
Yikes. Okay, let's unpack this. Before we get to why they're broken, we need to understand what these old reliable brakes actually were. What was the cheat code in the past?
So historically, the U.S. government had three main methods. The first one is just blunt force. It's what we might call the nuclear option.
Confiscation.
Confiscation.
Right, the 1933 playbook. I remember hearing about this, but walk us through it again.
It was startlingly direct. Under the FDR administration, during the absolute depths of the Great Depression, the government explicitly banned the private ownership of monetary gold.
So they made it illegal to have it.
Yes. Executive Order 6102, they forced citizens to turn it into the Federal Reserve in exchange for paper currency.
It's essentially like a teacher in elementary school seeing a toy that's distracting the class, walking over and just physically taking it away.
That's it, exactly.
You can't trade it or play with it if you don't have it.
Precisely. It physically absorbs the supply. If you make it illegal to hold the asset, you destroy the market for it. That was method one, absolute control.
Okay, that's intense. What was the second method?
Method two is the interest rate hammer, famously used by Paul Volcker in the 1980s.
The Volcker shock. Yeah, you hear economists talk about this all the time.
Right. In the late 70s and early 80s, we had massive inflation. Gold was skyrocketing. So Paul Volcker, the chairman of the Fed, he raised interest rates to nearly 20%.
20%. I mean, that's unimaginable today.
It was huge. But think about the mechanism here. Why does that hurt gold? Well, gold pays you zero interest. It just sits in a vault. It's a rock.
Right. It doesn't write you a dividend check. In fact, you have to pay to store it.
Exactly. But the dollar, if the bank is paying you 20% interest just to hold cash, what do?
I sell the gold immediately. I'm not going to sit on a rock when I can get a guaranteed 20% return on my cash. It's a no-brainer.
Exactly. You crush gold with yield. High rates make the dollar incredibly attractive, and gold, well, mathematically useless. That was the second break.
Okay, so we have steal it with confiscation and make the dollar pay huge interest with the Volcker shock. What's the third one?
The third one is a bit more technical, but very effective. It operates in the paper markets, the futures exchanges, where traders bet on the price of gold without actually touching it.
Ah, margin hikes.
Margin hikes, exactly.
Okay, I see this term margin thrown around a lot. Break this down for us simply. How does a margin hike crash the price?
Think of the futures market like a casino. You don't need the full price of the gold to bet on it. You just need a down payment or margin.
So it's leverage.
Right. Let's say you want to control $100,000 worth of gold. In the futures market, you might only need to put down, say, $5,000 in cash to open that bet.
Wow. So I can control a lot of gold with just a little bit of money?
Exactly, but the exchange authorities, they set the rules. If the price of gold is getting too high and they want to cool it down, they can suddenly say, hey, we're changing the rules. You now need $50,000 cash to keep that position open.
Ah, I see. So it's like the casino pit boss walking up to the table and saying, the minimum bet just went up 10x.
Perfect analogy.
All the little guys, the speculators who are driving the price up using borrowed money, they can't afford that.
Exactly. They get a margin call. They don't have the extra cash, so they're forced to fold their hands, which means selling their gold contracts immediately.
And when everyone sells at once,
The price crashes. It creates a liquidity flush. We saw this happen back in 2011. Gold touched 1900 and then got slammed down hard because they raised the margin requirements.
okay, so those are the three breaks: confiscation, high interest rates, and margin hikes. They worked for nearly 100 years. So here we are, it's 2026. Gold is at 5,100. Why not just do that again?
And here is where the story shifts. And this is the core of the new analysis. Let's
Yeah.
start with confiscation.
Okay, why not just ban it?
In 1933, the government could do that because the financial ecosystem was, a walled garden. They had absolute control. But in 2026, we have a massive problem called technology.
You mean the internet, crypto.
Exactly. Think about where money can go today. In 1933, you couldn't email your wealth to a server in Switzerland or Singapore.
Right.
Today we have Bitcoin, stablecoins, DeFi. The capital mobility today is instant and global.
So if the U.S. government says hand over your gold, people aren't going to just line up at the bank.
No, they will likely say, okay, I see the U.S. is panicking. I'm moving my wealth entirely out of the U.S. system. The analysis calls it a self-admission.
The signal of weakness.
It's the government admitting the dollar is broken and we are desperate. Instead of trapping money in the U.S., it would trigger a massive de-dollarization event.
Wow. So the brake backfires. Instead of stopping the car, you just scare all the passengers into jumping out.
Precisely. So the confiscation brake is effectively cut.
Okay, that makes sense. You can't lock the doors when there are digital windows everywhere. What about the Volcker method? This seems like the most logical one. I mean, even with the current administration, inflation has been sticky. Why not just jack up interest rates?
This is the biggest trap of all, and it centers on a concept that is absolutely critical for our listeners to understand. It's called fiscal dominance.
Fiscal dominance. It sounds like a bad heavy metal band. What does it actually mean?
It basically means the national debt is so big that it bosses around the monetary policy.
Okay.
In the Volcker era, the U.S. national debt was relatively low, about 30% of GDP. The government could afford to pay high interest rates on its debt without going broke.
But today, we're in a different world.
A completely different world. In 2026, the debt pile is massive. We are looking at over $36 trillion. And here's the data point that matters most: the annual interest cost.
Just the interest payments.
Just the interest, the money the government pays just to service that debt, is already hovering around $1 trillion a year.
Wow.
Now, let's play out the Volcker scenario.
Yeah.
If the Fed raises rates to, say, 15% to crush gold, what happens to that interest payment?
It explodes.
Hmm.
I mean, if the rate doubles or triples, the interest payment has to double or triple.
Exactly. The interest payments on the national debt would go from $1 trillion to $3 trillion, maybe $4 trillion a year. That is more than the entire tax revenue of the country.
So the government would instantly go bankrupt. They wouldn't be able to pay the military, Social Security, anything.
Right. So where would they get the money to pay that $3 trillion in interest?
They can't tax enough to cover that.
So they have to print it.
Oh, the irony. I see where this is going.
It's the ultimate irony. To stop inflation and crush gold, they raise rates.
Yeah.
But raising rates forces them to print more money to pay the bondholders, which creates more inflation and makes gold more attractive.
It's like trying to put out a grease fire in your kitchen by turning on a hose. But the hose is pumping gasoline.
That is the perfect analogy. You cannot use the interest rate hammer when you are the biggest debtor in the world. It's a suicide pill. The math just doesn't work.
That is actually terrifying. It sounds like a doom loop.
Okay.
So break one, confiscation, creates a panic. Break two,
Yeah.
high rates, bankrupts the government. What about break three, the casino trick?
Yeah.
Just raise the margin requirements.
Mm-hmm.
That's just a paper market rule, right?
Yeah.
Doesn't cost the government anything.
It is just a paper rule. And historically it worked because the paper market, the futures market in New York and London, it dictated the global price.
Well, not anymore.
But the sources we're looking at highlight a massive shift in 2026, the rise of the Eastern physical market.
We're talking about countries like China, India, Brazil.
Correct. And this is a crucial distinction. In the West, traders often treat gold like a tech stock. They buy a contract, hope it goes up, and sell it for cash. They don't want the actual heavy bars of metal.
Right, I don't want a pallet of gold sitting in my living room.
But the buyers in Shanghai, in Mumbai, the
Yeah.
central banks in the East, they are taking delivery. They want the real thing. They are draining the vaults.
Okay, so play this out. If the U.S. raises margins to crash the paper price, let's say they manage to smash the price on the screen down to $4,000 temporarily.
The chart looks ugly to a New York trader, but the buyers in Shanghai look at that screen and say, thank you for the discount.
And they buy more.
They buy everything. If the paper price drops below the real value, the East just accelerates the drain of physical metal from the West.
I see the problem. It's like a Best Buy lowering the price of TVs on their website to make them look cheap. But then a competitor comes in with a fleet of trucks and buys every single actual TV in the warehouse.
Exactly. Now your warehouse is empty. And when the warehouse is empty, what happens to the price of the few remaining TVs?
It skyrockets.
It explodes. This is the vault risk or run-on-the-bank scenario mentioned in the analysis. If the Western vaults, the COMEX, the LBMA, run low on physical metal, you get a decoupling.
A decoupling.
The paper price on the screen becomes meaningless because there's no metal behind it. The real price for actual physical gold goes to the moon.
So using the paper market to manipulate the price actually accelerates the loss of this strategic asset. The West loses its gold reserves to the East. That sounds like a national security disaster.
It is a strategic disaster, and that is why they can't simply hike margins and walk away. They risk breaking the entire mechanism.
Wow, so the car really has no brakes. Confiscation destroys trust. High rates destroy the budget. Margin hikes lose the physical metal. So what does the U.S. do? Just sit there and watch gold hit 10,000?
Well, there is a fascinating, almost conspiratorial theory gaining traction in 2026. It's the if you can't beat 'em, join 'em strategy.
What does that look like?
It involves something called the gold revaluation account, or GRA.
I've never heard of that. What is the GRA?
It's a line item on the Federal Reserve's balance sheet. Did you know the U.S. Treasury still lists its gold holdings on the official books at a statutory rate of $42.22 per ounce?
Wait, seriously, $42? I can't even buy a decent steak for $42? It's trading at over $5,000.
Right. It's an accounting relic from the 1970s. The U.S. holds about 8,100 tons of gold. On the books, it's worth almost nothing. But if the Treasury simply decided to mark to market, to revalue that gold at today's price...
We'll do some quick mental math. 8,000 tons times 5,000 an ounce. That's massive.
It creates about $1.3 trillion in new equity on the Federal Reserve's balance sheet instantly.
Without printing a single dollar.
Exactly. It's like realizing you have a rare painting in your attic that you thought was a cheap poster. You didn't earn new money, but your solvency just skyrocketed.
So it cleans up the balance sheet, makes the dollar look backed by something real again.
It's a way to use the high gold price to save the system rather than fighting it.
That sounds like a magic bullet. If they can just wave a wand and fix the balance sheet, why haven't they done it?
Because there is a catch. There's always a catch in macroeconomics.
Of course there is.
Who else holds a massive amount of gold?
China, Russia.
Right. And China likely holds a lot more than they officially report. If the U.S. revalues gold to $5,000 or $10,000 to save the dollar, they are simultaneously handing a massive wealth transfer to their biggest geopolitical rivals.
It boosts our balance sheet, but it might boost theirs even more.
Exactly. It validates China's entire strategy of hoarding gold. It's a staring contest.
And if the U.S. acknowledges gold is money, the dollar's monopoly is officially over.
The fact that we're even discussing this shows how much the landscape has shifted. The old rules where the U.S. just smacks gold down, they're gone.
This is a lot to process and feels like we're watching a tectonic shift in real time. But I want to bring this down to earth. I'm listening to this. I'm a normal person and I'm not a central bank. What does this mean for me? What's it?
The biggest takeaway for you, for the individual learner, is a mindset shift. You need to stop looking at gold as a way to trade or make a quick buck.
You mean don't buy it just hoping it goes up next week so you can sell it for more dollars?
Right. That's the old thinking. In this environment, with these brakes broken, gold isn't a stock. It is insurance against policy failure.
Insurance. That's a very different vibe than investment.
Think about who the biggest buyers are right now. The sources emphasize this repeatedly. Follow the whales. Central banks are buying gold hand over fist.
And they are not day traders.
No. They are the insiders. They run the financial system. If the owners of the casino are buying fire insurance on the casino,
You should probably pay attention.
you should probably pay attention. They are hedging against the system they operate.
That is a chilling but very clear analogy. If the casino boss is worried about the building burning down, I probably shouldn't keep all my chips on the table.
Exactly. And practically, this comes down to understanding real rates. This is the key metric for you to watch.
Break that down. We hear real rates a lot, but define it simply.
Don't look at the nominal interest rate, the number on your savings account. Let's say the bank pays you 4%. That sounds okay. But if inflation is 5%,
Then I'm losing 1% of my purchasing power every year.
yeah,
My money buys less stuff.
exactly. That is a negative real rate. And here is the kicker. As long as the U.S. is trapped by fiscal dominance, that debt trap we discussed, they have to keep interest rates lower than inflation.
They can't afford positive real rates because the debt is too high.
Correct. They have to inflate away the debt. That means real rates will likely stay negative or very low for a long time. And history shows that negative real rates are rocket fuel for gold.
So for the listener, this isn't about panic. It's about diversification. It's about understanding that the dollar has a constraint today that it didn't have in 1980.
It's about realizing the brakes are broken, so maybe you want to be in a vehicle that doesn't rely on those brakes.
Well said. You know, it's funny, we spent the whole time talking about how the U.S. can't stop gold. But if that revaluation theory is right, we might end up in a world where the U.S. actually wants gold to go higher.
That is the final irony. After 100 years of fighting gold, of suppressing the price to protect the dollar, the Federal Reserve might end up becoming the biggest gold bug of them all, just to balance the books.
What a time to be alive, watching 100 years of economic history flip on its head.
It certainly keeps things interesting.
Well, that's all the time we have for this deep dive. A huge thank you for breaking down these complex mechanics. It's scary, but it makes sense.
My pleasure.
And to our listeners, thanks for tuning in to Investment Insight. Don't forget to subscribe and hit that like button. We'll catch you next time.